The volatile world of cryptocurrency is once again at a critical juncture, with market observers noting eerie similarities to past boom and bust cycles, even as the digital asset space grapples with an escalating wave of sophisticated hacks, brazen scams, and alarming real-world crime. This confluence of speculative fervor and heightened risk underscores the complex and often perilous landscape of decentralized finance. Vision CEO Raoul Pal, a prominent voice in the crypto community, recently articulated this sentiment, remarking that the current crypto cycle is playing out spookily similar to 2017, a year remembered for its dramatic bull run followed by a significant correction. This observation, reported by Cointelegraph on June 21, 2025, suggests a potential for significant market movements fueled by renewed retail interest and increasing institutional adoption. However, such periods of rapid growth often coincide with amplified risks, attracting both legitimate innovation and illicit opportunism. Indeed, the past week has cast a stark light on the darker underbelly of the crypto ecosystem. Fox Business reported on June 21, 2025, that an Iranian crypto exchange suffered a significant hack, prompting an expert to warn of an impending war of codes. This incident highlights the relentless and evolving nature of cyber threats targeting digital asset platforms. As the value of cryptocurrencies climbs, so too does the incentive for bad actors to exploit vulnerabilities, leading to potentially devastating financial losses for users and a broader erosion of trust in the security infrastructure of exchanges. The expert's warning suggests a future where cyber warfare in the crypto realm becomes increasingly sophisticated and pervasive, demanding more robust defense mechanisms and international cooperation. Beyond large-scale hacks, the human cost of crypto-related crime is becoming increasingly apparent and disturbingly violent. NewsTimes reported on June 21, 2025. That a Connecticut resident pleaded guilty in connection with a staggering $245 million crypto heist, an event so severe it reportedly led to the kidnapping of his parents. This chilling incident serves as a stark reminder that the consequences of digital theft can transcend the virtual realm, spilling into the physical world with severe and life-threatening repercussions. It underscores the growing link between high-value digital assets and traditional organized crime, pushing law enforcement to adapt to new forms of criminal enterprise. Meanwhile, the pervasive issue of fraud continues to prey on unsuspecting investors, often under the guise of education or investment opportunities. The Denver Post revealed on June 21, 2025, details of a phony Denver crypto school that allegedly defrauded a Florida man of a staggering $860,000. Such schemes capitalize on individuals' desire to enter the burgeoning crypto market, promising expertise or guaranteed returns, only to leave victims financially devastated. The proliferation of these deceptive operations highlights a critical need for enhanced investor education and due diligence, as well as more stringent regulatory oversight to protect consumers from sophisticated financial scams. The convergence of these trends, a potentially resurgent market cycle, escalating cyber attacks, and the grim reality of crypto-linked crime, paints a complex picture for the future of digital assets. While the promise of decentralized finance continues to attract significant interest and investment, the events of the past week unequivocally demonstrate the urgent need for comprehensive security measures, robust regulatory frameworks, and heightened user awareness. As the industry matures, its ability to mitigate these inherent risks will be paramount in determining whether the next crypto cycle leads to sustainable growth or another painful reckoning. Emphasizing that the journey towards mainstream adoption is fraught with both immense opportunity and significant peril, the cryptocurrency market finds itself at a pivotal juncture, navigating a complex interplay of macroeconomic forces, internal protocol developments, and the continuous emergence of new projects. As of Saturday, June 21, 2025, the broader crypto landscape remains largely flat, a direct reflection of the Federal Reserve's recent decision to hold interest rates steady as observed by the defiant. However, beneath this calm surface, significant tremors are being felt, with analysts from Forbes warning of a potential $37 trillion Fed price earthquake for Bitcoin, a scenario amplified by sudden shifts in political sentiment, including former President Trump's evolving stance on digital assets. This macroeconomic stability, or rather the lack of significant movement from the Fed, has created a holding pattern for many digital assets. While a consistent rate environment typically reduces immediate volatility, it also leaves the market susceptible to sudden shifts should the Fed signal a change in its monetary policy or if broader economic indicators diverge from expectations. The specter of a massive capital reallocation potentially triggered by a significant policy pivot underscores the profound impact traditional financial mechanisms continue to exert on the nascent crypto economy. The Forbes report highlights the scale of potential disruption, emphasizing that even seemingly subtle shifts in the financial establishment or political rhetoric can have colossal implications for Bitcoin's valuation, drawing attention to the intricate dance between cryptocurrency and global finance. Adding another layer of complexity to Bitcoin's trajectory are internal debates within its technical community. Cointelegraph reports that Bitcoin Knots, an alternative implementation of the Bitcoin protocol, is steadily gaining ground. This development raises critical questions about the network's future, particularly the potential for a chain split. A scenario where the blockchain diverges into two separate chains with different rule sets. Such an event, while not unprecedented in the crypto space, introduces significant uncertainty for investors and could have a detrimental impact on Bitcoin's price by fragmenting liquidity and trust. The rise of alternative clients like Bitcoin Knots often signals fundamental disagreements within the developer community regarding scalability, security, or decentralization, and how these debates resolve will be crucial for the network's long-term health and stability. Despite these prevailing uncertainties and the looming threat of a protocol schism, the Bitcoin ecosystem continues to expand and innovate. Globe Newswire announced that Bitcoin Solaris, a new project, is entering its final pre-sale phase, anticipating a full launch in July. This move demonstrates the ongoing drive for new ventures and applications within the broader Bitcoin-aligned space, seeking to capitalize on the foundational technology while perhaps offering novel features or use cases. The successful progression of such projects, even amidst market flatness and internal technical debates, highlights the persistent entrepreneurial spirit and investment interest in the digital asset sector. Looking ahead, the cryptocurrency market, and Bitcoin in particular, remains poised on the edge of significant developments. The immediate future will undoubtedly be shaped by the Federal Reserve's subsequent policy decisions, which could either reinforce the current flat trend or unleash the price earthquake that analysts fear. Simultaneously, the internal dialogue surrounding Bitcoin's protocol, specifically the traction gained by Bitcoin Knots and the implications of a potential chain split, will be a critical determinant of its technical and economic resilience. Amidst these macro and micro pressures, the continuous emergence of new projects like Bitcoin Solaris serves as a reminder of the industry's dynamic nature and its relentless pursuit of innovation, ensuring that the journey of digital assets will remain anything but uneventful. The cryptocurrency market is once again at a critical juncture, navigating the turbulent waters where digital assets intersect with high-stakes politics and macroeconomic policy. Recent reports suggest a profound shift is underway, with Bitcoin, the world's leading cryptocurrency, potentially bracing for a seismic price earthquake driven by a sudden flip in former President Donald Trump's stance and the broader implications for Federal Reserve policy. This confluence of political rhetoric, speculative assets, and institutional sentiment paints a complex picture for investors and enthusiasts alike. Forbes recently highlighted the potential for a staggering $37 trillion impact on the market, directly linking it to a perceived change in Trump's position. While the specifics of this flip remain a subject of intense speculation among market watchers, the mere suggestion of a shift from such a prominent figure is enough to send ripples through the highly sensitive crypto ecosystem. Analysts contend that any change in the political landscape, particularly concerning an administration's approach to fiscal spending or regulatory oversight, could directly influence the Federal Reserve's monetary policies. A more expansionary or interventionist stance, for instance, could lead to inflationary pressures or a re-evaluation of interest rates, factors that have historically had a significant, albeit often inverse, correlation with Bitcoin's valuation as a hedge against traditional financial instability. The underlying concern for many is that a shift in presidential policy could either usher in an era of greater acceptance and regulatory clarity for digital assets or conversely, introduce new hurdles that challenge their growth trajectory. Adding to the complexity, hedge fund executives are reportedly expressing growing anxieties about Bitcoin's prospects in a post-Trump world as detailed by Cointelegraph. This sentiment underscores a broader institutional apprehension regarding the stability and predictability of the crypto market under evolving political leadership. For large-scale investors, regulatory certainty is paramount. Any ambiguity surrounding taxation, classification of digital assets, or the legality of certain crypto operations can deter significant capital inflows and even prompt divestment. The perceived political leanings towards or against crypto innovation could dictate the pace of adoption and integration into traditional financial systems, directly impacting Bitcoin's long-term price stability and mainstream appeal. Beyond Bitcoin, the direct intersection of politics and cryptocurrency has manifested in more unconventional ways. The Sarajevo Times reported on how the dollar Trump meme coin has dramatically shook the cryptocurrency market. Meme coins, characterized by their speculative nature and community-driven valuations often tied to internet culture or public figures, have found an unexpected stage in political discourse. The emergence and significant trading volume of a coin directly named after a major political figure illustrate the powerful, sometimes irrational influence of personality and narrative in the crypto space. This phenomenon highlights a growing trend where digital tokens become extensions of political movements or fan bases driven by hype and social media engagement rather than traditional utility or underlying technology. The rapid rise and fall of such assets underscore the extreme volatility and risk inherent in this segment of the market, often leaving retail investors vulnerable to sharp price swings. However, the narrative around these politically themed tokens is not without its controversies. Bitcoinist.com recently reported that TikTok has vehemently denied claims of facilitating Trump coin purchases, pushing back against a congressman's assertions. This denial emphasizes the ongoing struggle for accuracy and transparency in the digital asset space, especially when political figures or platforms are involved. It also brings to light the challenges of regulating and monitoring the flow of information and transactions in a decentralized environment where misinformation can spread rapidly and influence market behavior. The incident serves as a reminder of the need for rigorous verification and the potential for political actors to leverage emerging technologies for their own ends, whether through direct endorsement or the unintentional creation of market phenomena. Looking ahead, the cryptocurrency market appears inextricably linked to the political and economic machinations of the global stage. The evolving stance of influential figures like Donald Trump, the subsequent impact on the Federal Reserve's policies, and the speculative fervor surrounding politically themed meme coins will continue to shape the trajectory of digital assets. Investors will need to remain exceptionally vigilant not only to technological developments and market fundamentals but also to the shifting sands of political rhetoric and regulatory frameworks. The coming months will likely test the resilience and adaptability of the crypto market as it strives to mature amidst an increasingly complex interplay of technology, finance, and politics. The cryptocurrency market finds itself navigating a familiar period of cautious consolidation, with recent movements largely flatlining as participants digest the Federal Reserve's latest decision to maintain interest rates. This macroeconomic steadiness, while offering a degree of predictability, has seemingly curbed the immediate catalysts for significant upward momentum across the digital asset landscape, leaving many investors in a holding pattern. The defiant reporting on Saturday, June 21, 2025, underscored this sentiment. Noting the market's subdued reaction to the Fed's unchanged policy stance, a move that typically reflects the central bank's assessment of a stable albeit not rapidly expanding economic environment. Such an environment often translates to a wait-and-see approach and risk-on assets like cryptocurrencies as capital remains sensitive to shifts in global monetary policy. Amidst this broader market inertia, all eyes remain firmly fixed on Ethereum, the second largest cryptocurrency by market capitalization, whose future trajectory continues to be a hot topic of debate and speculation. While the immediate market reaction to the Fed's decision was muted, long-term projections for ETH vary wildly, reflecting both the underlying strength of its ecosystem and the inherent volatility of the crypto space. Analysts at TradingView, for instance, in their Saturday report posed the question of whether Ethereum could reach the $3,000 mark in the coming years, specifically looking at 2025 through 2030. This more conservative outlook likely factors in potential regulatory headwinds, broader market corrections, or a slower pace of mainstream adoption. However, a decidedly more bullish perspective emerged from CoinTribune on the same day, suggesting that Ethereum could be on the way to $8,000, heralding 2025 as a legendary year for the asset. This optimistic forecast is likely underpinned by anticipated advancements within the Ethereum network itself, such as continued improvements in scalability and efficiency, the sustained growth of decentralized finance DeFi applications, the burgeoning non-fungible token NFT market, and increasing institutional interest. The divergence in these predictions highlights the complex interplay of fundamental technological progress, market sentiment, and external economic forces that dictate cryptocurrency valuations. The potential for significant network upgrades and the expanding utility of the Ethereum blockchain are often cited as key drivers for long-term appreciation. Irrespective of short-term market fluctuations influenced by central bank policies, the speculative fervor surrounding the next big crypto opportunity also persists, fueled by the staggering historical gains of early adopters of established assets. A report by MSN on Saturday drew a compelling parallel, suggesting that investing in a new unnamed crypto coin at a mere 3 cents could be akin to buying Ethereum when it was priced at just $5. This narrative, while promotional in nature, perfectly encapsulates the ongoing hunt for the next Ethereum, a low-cap asset with the potential for exponential growth. Such comparisons underscore the deep-seated desire among investors to replicate the success stories of the past, often overlooking the significant risks associated with nascent projects. It reflects a market where, despite macroeconomic caution, the pursuit of groundbreaking returns remains a powerful motivator, driving interest towards innovative, albeit unproven, ventures. Looking ahead, the cryptocurrency market remains a dynamic interplay of macroeconomic forces, technological innovation, and speculative appetite. While the Federal Reserve's consistent interest rate policy provides a stable, if not immediately stimulating backdrop, the focus will increasingly shift to Ethereum's fundamental developments and the broader adoption of decentralized technologies. The varying price predictions for ETH underscore the significant upside potential contingent on successful network evolution and sustained ecosystem growth. Simultaneously, the continued search for the next big thing will likely ensure a vibrant, albeit risky, landscape for early-stage crypto projects. Investors will continue to monitor global economic indicators, regulatory developments, and the pace of technological advancement within leading blockchains, as these factors collectively shape the trajectory of the digital asset economy in the coming years. The cryptocurrency market continues its relentless evolution, a landscape where established blockchains vie for dominance while innovative projects emerge daily, all against a backdrop of increasing institutional interest. Recent days have seen a flurry of activity, particularly around the Solana ecosystem, which is simultaneously embracing new liquidity solutions and grappling with its own internal market dynamics, even as the broader industry eyes the next wave of mainstream adoption through novel financial products. A significant development bolstering Solana's burgeoning decentralized finance DeFi ecosystem comes from OKX, a leading global cryptocurrency exchange. OKX has just launched xBTC, a 1:1 Bitcoin-backed token on the high-throughput Solana blockchain. This strategic move is designed to bridge the vast liquidity of Bitcoin into Solana's vibrant DeFi landscape, offering users more avenues for capital efficiency and yield generation. To incentivize adoption, OKX, in collaboration with prominent Solana-based protocols Mutuum Finance and Orca, is offering over $250,000 in rewards, underscoring the collective effort to enhance Solana's utility as a destination for wrapped Bitcoin. This initiative directly addresses a critical need within the DeFi space, enabling Bitcoin holders to participate in faster, cheaper, and more scalable decentralized applications without having to sell their BTC. However, Solana's journey hasn't been without its recent turbulence. The network has reportedly experienced some slippage attributed by observers to meme coin mayhem. This phenomenon, characterized by rapid price swings and high trading volumes of speculative meme-based cryptocurrencies, can sometimes strain network resources and lead to volatility in the underlying blockchain's native token SOL. Despite this recent dip, technical chart analyses suggest a possible comeback for Solana, indicating underlying resilience and perhaps a market correction following the speculative fervor. This dual narrative highlights the inherent challenges and opportunities within a rapidly maturing but still highly speculative market segment. Beyond individual blockchain performance, the broader crypto market is abuzz with anticipation for the potential launch of new exchange-traded funds ETFs. Following the successful introductions of Bitcoin and Ethereum, ETFs' attention has now shifted to other major altcoins, with speculation mounting around the imminent possibility of XRP and Dogecoin ETFs. Should these come to fruition, they could significantly broaden institutional and retail access to these cryptocurrencies, potentially triggering substantial price appreciation and further legitimizing the asset class in traditional finance. The move towards more diversified crypto ETFs signals a growing acceptance and demand for regulated investment vehicles within the digital asset space. Amidst these macro-level shifts and specific blockchain developments, the market continues to be a fertile ground for new projects promising exponential returns. One such contender making headlines is Mutuum Finance MUTM, a new cryptocurrency that some experts are touting could deliver an astonishing 13,100% return on investment. This kind of speculative forecast underscores the high-risk, high-reward nature that still defines a significant portion of the cryptocurrency market, attracting investors seeking outsized gains while simultaneously cautioning about the inherent volatility and uncertainty associated with nascent projects. In essence, the digital asset ecosystem remains a dynamic frontier. Solana's strategic moves to integrate Bitcoin liquidity even as it navigates the whims of meme coin trading underscore the ongoing efforts to build robust and versatile blockchain infrastructure. Simultaneously, the industry's push for new ETF products points towards a future of greater institutional integration and mainstream accessibility. Yet the persistent allure of new, high-potential cryptocurrencies like Mutuum Finance reminds us that the spirit of decentralized innovation and speculative investment continues to thrive, shaping a landscape that is as unpredictable as it is transformative.